Well, welcome back to the Money Hour with your host and mortgage expert, Tina Mitchell, right here on 1150 AM KKNW, the Saturday, May 23rd show, bringing in expert advice and inside knowledge on today's events in our local economy and how it can affect your money. If you're listening to my show at a different time or day, you are listening to a rebroadcast, but you can call the show at 1-855-400-1150 or always go online to themoneyhour.com with any questions, or more importantly, if you want to connect with any of the guests that I have in studio. Right now, I've got Michael Orbino with John L. Scott. Michael, I'm so happy to have you back in studio. I'm just really excited about our conversation today. Thanks for coming in.
Yeah, thanks, Tina. It's always fun to be here with you.
And anybody that's listening, this is just really an exciting topic, talking about what's happening in protection for home ownership. And so that's really why Michael's in studio. And again, it's just going to be an exciting conversation with him. Little background about Michael: began his real estate career at John L. Scott downtown Bellevue office in 2002 as the youngest agent hired in the company's number one producing office, and is now the managing broker. He holds a number of Realtor designations. In 2009, Michael, co-founder of Relay with partner David Mills, as a division with John L. Scott that specializes in recruiting, training, and staffing new construction communities with only the highest quality salespeople. Additional service areas include experience in pro forma analyst, land development, product mix, marketing plans, and sales execution. Michael's has recently been featured on the cover of Washington Realtors magazine and contributed to articles in Wall Street Journal and the Seattle Times, among many others. Now, Michael remains actively involved in the industry level leadership by serving as the National Association of Realtors federal political coordinator for the 1st District of Washington. He also serves on the board of directors for the Urban Land Institute, Younger Leaders Group, and the Seattle King County Realtors Governmental Affairs Committee. That is quite a list of just really powerful positions that you have, Michael. And I just want to mention that because you're doing so much to help our consumers and the community as far as everything that's going. So Michael's proudest achievement comes from serving 6 years in the United States Army Reserve as a finance soldier with 1 year active duty tours from Operations Noble Eagle and Iraqi Freedom. Thank you so much again for Michael for being here. So let's go ahead and start out with, there's a lot of buzz around the mortgage interest deduction, and are we at risk of that going away, Michael?
Well, Tina, first of all, thank you for the kind introduction. I thought you were going to truncate that biography a little bit.
I couldn't. There's so much good stuff there. I couldn't bring it down.
As a fellow guest, I'm probably a little embarrassed by that. But, mortgage interest deduction is obviously near and dear to realtors, and I'm sure mortgage professionals as well. So it's a topic that we are always have a hyper awareness of when there's a conversation around it. I think generally... our general feeling is no, it's not at risk. How it would be at risk is there's oftentimes in election cycles, there's a discussion of a flat tax. Mm-hmm. A flat tax, I think to most reasonable people sounds like an exciting proposition because it basically says that X percentage of whatever we would all just pay, and it would be very simple and simplify the tax code. But what a lot of people I think don't appreciate or understand about a flat tax conversation is that the mortgage interest deduction is one of the largest deductions taken in the United States. It's also the single oldest deduction. It was the first on the books for any deduction. And it's something upwards of 73 million homeowners in this country use.
Yes.
And so that's why oftentimes with these election cycles, we tend to want to make sure that our legislators and our elected officials understand the importance of the mortgage interest deduction.
Yeah, and I think the benefit of homeownership is always going to be out there, but it definitely strengthens it when you've got that interest deduction. And if they did take it away, obviously it would have some effect on the strength of our economy based on homeownership. Now, can you explain, Michael, to my listeners what GSE Reform is and give us an update on that as well?
Sure. GSE is a government-sponsored entity, and essentially they govern Fannie Mae and Freddie Mac, which is, much closer to your industry than ours, but obviously they're intertwined. And I think the realtors have such a powerful voice in Capitol Hill that oftentimes we are asked and tasked to carry that message. Essentially, through the downturn, Fannie and Freddie both fell into conservatorship, which is essentially government control. These are no longer private entities. And so now that we're through that and the housing market's recovered, there's much discussion of how much liability for these mortgages should the federal government take on.
Okay.
In 2014, excuse me, I don't want to be wrong, so I'm going to give you the 2013 stats. 93% of all mortgages were underwritten by either Fannie, Freddie, FHA, or VA.
Makes sense.
And so there's a lot of people, no matter what your political leanings are, that think that 93% of all home loans being backed by the federal government is too hefty.
Yeah.
So part of that reform structure is how do we start to disengage the federal government from that policy and bring back private investors? And back to your point about the interest rates, that's much to do with it. When you have a single buyer of all your mortgages that is, has the full faith and credit of the United States government, interest rates will stay low.
Yes.
Our concern with a rapid reform of the GSEs is that it would spike interest rates too much too fast. And so that's where that reform piece comes in. It's not just about who carries the liability, it's what it does to the interest rate environment.
Makes total sense. So, Michael, what about the information that you have on FHA, and can you talk about FHA insurance premium?
Sure. Well, that was fun. It was fun. I visit DC often because that's my work takes me out there to do this. But actually had my first visit to the White House on Thursday. So,
oh, wow, how exciting.
And had a chance, thank you. And it was a pretty exciting
moment for me. So there's some benefits to all of the time commitment and the emotional commitment you put into these tasks that you take on.
There is.
Yes.
And, for me, it's an honor to do it, and I'm proud to do it and represent the realtors and the homeowners in this. So, but specifically with that White House meeting, we had a meeting with FHA director, deputy director, and talked specifically about that. Essentially, the reason for that rise in that insurance premium is the FHA is mandated to keep a certain amount of reserve capital.
Yep.
And they needed to raise that somewhat dramatically, at least we felt like it was dramatic, in order to cover that reserve. They have not met the reserve, but they're very near it. And so they've since lowered that insurance premium back down substantially. Our major question for the FHA director is, and a lot of people don't know this, and I know well-educated and well-informed loan officers like yourself are talking about this too, but I'm not convinced that every loan officer is talking about it, is the length of the mortgage insurance on your loan.
For the life of the loan.
Traditionally, yes, we've always understood it that once we hit a certain loan-to-value ratio, that it would be taken care of and it would be removed. Currently, as it exists, that was changed, I believe, almost 2 years ago, a year and a half ago.
Yeah.
Yeah, that it'll carry on for the life of your loan. And so that's our biggest interest with FHA right now, is going back to having a system in place that once you obtain a certain amount of equity at your home, that you would not be responsible for that insurance.
Yeah, and it's probably it's less than 2 years, but time goes by so quick, it's hard to keep up with it sometimes. But there was always a minimum 5-year hold requirement on FHA, regardless of what you paid down on it, and then it would release. So I just tell consumers, it's just like you said, really having those reserves so that we can continue to lend on FHA, because FHA is the one that allows people to get in with challenging credit, down payment assistance, on all of those great things. Now with the lower, when they lowered it from the 1.35 to the 0.85, that was just another $30,000 increase in buying power if you're in that $300,000 to $350,000 range. So that was pretty cool. So what's happening in the USDA Rural Home Loan Program expansion? Well,
these are some exciting areas. I always call USDA the forgotten zero-down loan program.
It is.
It is something that the USDA administers, and it's very similar to the VA, in which we can get into. I'm a beneficiary of the VA and a user of the VA home loan. But just like the VA, the USDA will back these mortgages and guarantee them at zero down for certain populations. So essentially what they're trying to do is incentivize people to look at, we can't all just live in the city. And nor do all of us want to. And so, small rural towns, farming communities, and it's not just what you would think of as a farm. The USDA is applicable to, once you take King, Snohomish, and Pierce County out of the mix, and maybe some areas around Spokane, most of the state would qualify for USDA. And so even areas within Snohomish County like Sultan, Gold Bar, I believe that they're eligible in those ranges. And the USDA actually also does direct lending as well, not just loan guarantees.
Yeah, so USDA increased their mortgage insurance as well, but they took it to where it's amortized over 30 years. So basically, you're just paying a little bit less every month on that. Before I run out of time with you, Michael, because I could have you here for the entire show, I've got to ask you, what is the patent trolling, and how could this affect your community, the real estate professionals?
Sure. Patent trolling is an issue that's near and dear to our representatives because we are one of the technology capitals of the U.S. I mean, maybe arguably behind Silicon Valley, and most would consider us the Silicon Valley of the Pacific Northwest. And so patent trolling is a lot of our professionals are getting caught up in this, where they receive a letter from a law firm that essentially says, we have rights to patents that are included in your fax machine, in your copy machine, on your website. Your drop-down menu is using a patent that we bought. And if you pay us, we will go away. If not, there's going to be litigation filed and you will land in court. The realtors' stance on this is we value intellectual property. We want people, if people are violating patents. But the problem is the how it currently exists is you don't really have to give any explanation for why you're threatening somebody with a patent lawsuit.
Okay.
We are asking Congress to step in and basically say, because us as independent practitioners, we're such easy targets.
Yeah.
And this is going on all over the United States. Realtors are paying $500, $800, thousands of dollars to just make these patent litigation lawsuits. It's essentially a low-grade extortion is our feeling on it. And so we just want law firms that are engaging in that to basically be able to back up. And it's something that's bigger than our industry. It's going on all over.
Yeah.
But we're scared of it because our members, like I said, as independent practitioners, are very susceptible to those kind of threats.
Michael, wrap up. I want you to give a call to action for my listeners out there. What they should be doing right now that you think is most important in helping.
Sure. I think for your listeners that are real estate professionals and the loan officers, I think have an awareness of what's going on. Don't take these things for granted. That's what I'm always surprised, that we just assume things will happen forever. We didn't get into things like the 1031 tax exchange is also on the chopping block, and that is reality. And so I would hope that they would be educated, and by being educated, then they can pass on that information to their clients and be a better practitioner. As for the individual homeowners and listeners out there, I just really hope that you continue to be engaged. And when you hear things like this, write a letter. You'd be surprised, the power of individual voices and constituents. The elected officials want to hear from you. Their staff wants to understand your problems and your concerns. And so please be that voice. And because these are all things that it's so easy to take for granted, but when they're taken away, they would be devastating. I'll give you one quick statistic. I mean, we estimate if we lost the mortgage interest deduction, that all home values would be immediately depressed by 18% overnight. Wow. So, these things are hinged together, important. And reasonable people can make movements, but it's the extreme shocks to the system that we don't want, and that's what we don't like.
Well, Michael, again, thank you so much for taking time to come into studio and for all that you do to help protect homeownership, protect our economy, your real estate community, because as a top professional, I know that there's not a lot of extra time to do extra things. So I just appreciate you so much, and thanks for coming in.
Thanks for having me.
And coming up next in the Money Hour, are you moving to the Seattle area? You will not want to miss my next guest in studio, Justin Richards and Yvette Adubi with Keller Williams Realty Bellevue, discussing everything Seattle right here on 1150 AM KKNW.